Hey everyone, welcome back to the channel. Today, we're diving into a topic that's been on everyone's mind, the incredible, almost unbelievable price surges in gold and silver, and the potential for a massive crash that could follow. We've seen predictions of gold hitting $5,600 an ounce and silver soaring to $121. Are these numbers pure fantasy, or are they rooted in real economic trends? And more importantly, what does it mean for you and your investments? Let's break it down. First, let's understand why these prices aren't just pulled out of thin air. The primary driver behind these predictions is the concept of monetary debasement and the potential shift away from the US dollar as the world's reserve currency. For decades, the dollar has been king. But lately, countries, particularly the BRICS nations Brazil, Russia, India, China, and South Africa, along with their new members, are actively looking for alternatives. They're settling trades in their own currencies, and most significantly, they are stockpiling gold at a record pace. Why gold? Because gold is the ultimate, universally accepted form of money. It has been for thousands of years. Unlike fiat currencies, which can be printed into oblivion by central banks, gold is finite. Its supply can't be artificially inflated. When central banks around the world print trillions of dollars, euros, and yen, the value of each individual currency unit goes down. This is inflation, and it's the hidden tax that erodes your savings. To protect their wealth from this erosion, nations and individuals are turning to gold. So how do we get to a number like $5,600 for gold? This isn't just a random guess. It's based on a historical precedent and some straightforward math. Let's look back at the 1970s. The US was facing massive inflation similar to what we're experiencing today. In 1971, President Nixon severed the US dollar's last link to gold, ending the Bretton Woods system. In the decade that followed, the price of gold skyrocketed. It went from $35 an ounce to over $850 by 1980. That's a massive increase. People were losing faith in the dollar, and they flocked to the safety of gold. Now, let's apply that logic to today. Some analysts calculate a fair value for gold by looking at the total amount of currency in circulation, specifically the M2 money supply, and comparing it to the amount of official gold reserves held by the central bank. If you were to back just a fraction of the US money supply with the Treasury gold holdings, say 40%, which was a historical benchmark, you would arrive at a gold price well over $10,000 an ounce. So, a prediction of $5,600 starts to look not just possible, but perhaps even conservative under certain economic scenarios. It represents a revaluation of gold against a currency that is being rapidly devalued. Now, let's talk about silver. Why $121? Silver is often called poor man's gold, but it's much more than that. It has a dual role. Like gold, it's a monetary metal, a store of value, but it's also a critical industrial metal. It's in your phone, your computer, solar panels, electric vehicles, and countless medical applications. The demand for silver from the industrial sector is exploding, especially with the global push towards green energy and electrification. The key thing to understand about silver is the gold-to-silver ratio. This ratio is simply the price of gold divided by the price of silver. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has hovered around 15-1. In ancient Rome, that was the legally set ratio. Today, the ratio is sitting somewhere around 80-1. This means silver is historically incredibly undervalued compared to gold. If gold were to reach $5,600 an ounce, and the gold-to-silver ratio were to start moving back towards its historical average, the price of silver would have to rise dramatically. Let's do the math. If the ratio returned to a more modern average of, say, 50-1, with gold at $5,600, that would put silver at $112 an ounce. If it went to 40-1, you're looking at $140 for silver. So the $121 figure is right in that ballpark. It assumes not only a rise in gold, but also a correction in the gold-to-silver ratio, as investors realize just how cheap silver is. But the title of this video also mentions a brutal crash. Where does that come in? This is the other side of the coin, and it's critically important to understand. Markets don't move in straight lines. The path to $5,600 gold and $121 silver will likely be filled with extreme volatility. We could see sharp, gut-wrenching corrections along the way. Why? because the powers that be, the central banks and major financial institutions, have a vested interest in maintaining the current dollar-based system. They can, and often do, intervene in the markets to suppress the price of precious metals. They can use derivatives, futures contracts, and what's known as paper gold and paper silver to create artificial supply and drive prices down, even when physical demand is soaring. We've seen this happen time and time again. A wave of negative news, a sudden change in interest rate policy, or a coordinated sell-off in the paper markets can trigger a panic and cause a brutal crash, shaking out all the weak hands. Imagine this scenario. Gold is racing towards $3,000. Everyone is euphoric. Mainstream media is finally picking up the story. Your friends and family who once laughed at you for buying metals are now asking how they can get in. That is often the point of maximum risk. A sudden event, maybe a temporary resolution to a geopolitical crisis or a surprisingly strong economic report, could be used as an excuse to hammer the price down by 20% or more in a matter of days. This is the brutal crash we're talking about. It's designed to scare you into selling your physical metal at a loss, right before the next major leg up. The expert analysis suggests that any such crash would be a temporary manipulation, not a fundamental change in the long-term trend. The underlying reasons for owning gold and silver, the debasement of currency, the geopolitical shift away from the dollar, and the unsustainable levels of government debt are not going away. In fact, they're accelerating. A crash in the paper price would likely trigger an even bigger rush into the physical market, as smart investors use the opportunity to buy more at a discount. This could lead to a situation where the paper price and the physical price completely disconnect. You might see the price on your screen say silver is $25, but good luck trying to buy a physical ounce for less than $40 or $50. We saw a preview of this during the market turmoil of 2020. The supply of physical metal dried up almost overnight, and premiums skyrocketed. So what's the takeaway here? The predictions of $5,600 gold and $121 silver are based on sound economic reasoning, historical precedent, and the fundamental revaluation of real assets in an era of currency debasement. They are not a guarantee, but they represent a very real possibility in the years ahead. However, the journey will be a roller coaster. You must be prepared for extreme volatility and the possibility of brutal, manufactured crashes designed to shake you out of your position. The key is to understand why you own precious metals in the first place. It's not a get-rich-quick scheme. It's a long-term strategy to preserve your wealth and protect your purchasing power against the silent theft of inflation. If you understand the fundamentals, you'll see these crashes not as a disaster, but as a buying opportunity. Think long-term. Don't use leverage. Own the physical metal, not just a paper promise. And be prepared for a wild ride. The financial system is undergoing a historic transformation, and precious metals will play a central role. The question is, will you be prepared for it? Thanks so much for tuning in today. I hope this analysis gives you a clearer picture of what's happening in the gold and silver markets. If you found this video helpful, please hit that like button, and be sure to subscribe and click the bell so you don't miss our future updates. Let me know your thoughts in the comments below. Do you think these price targets are realistic? Until next time, stay safe and be well.